Welcome back to Investing Talk Podcast.
Good to be here.
Today we're focusing on Maxeon Solar Technologies. That's MAXN. You flagged this company for us, and we're going to analyze what you, our listeners, need to understand about them right now.
Okay. We've got material covering quite a bit here. Their background, how they've been doing recently, financial health.
Potential issues and strengths, too, I see.
Right. Plus, market sentiment, competitors, future plans. And there's a specific analysis from May 1st, 2025, plus a due diligence report.
So the goal is to pull all this together, synthesize it, so you get a clear picture of Maxeon.
Let's get into it.
Okay, so Maxeon, they launched in 2020, but they didn't come out of nowhere. They have a strong background in solar tech.
That's right. Known for high-efficiency panels like their Maxeon 3 and 6 series. Pretty advanced stuff.
And what really stands out is this big strategic move in 2025. They decided to focus only on the U.S. market.
A very significant pivot, concentrating everything stateside.
It is. And you have to wonder about the timing and the reasoning there. Maybe opportunities, maybe regulations.
Could be mix, believing in U.S. growth, maybe trying to leverage domestic policy. But it does concentrate the risk, doesn't it?
Definitely puts all their eggs in one basket, so to speak. Now, looking at recent performance, fiscal year 2024 revenue was, what, $509 million?
$509 million, which sounds okay until you compare it.
Right, compared to $1.12 billion in FY 2023. That's a huge drop.
A massive decline. And a lot of that seems tied to Q4 2024.
The U.S. customs issue. Those import restrictions on their panels hit them hard starting July 2024.
Yeah, that really choked their supply into their main, now only market.
And to manage this shift, they sold off non-U.S. assets, right? Brought in about $94 million.
Correct. That sale underscores just how serious this restructuring is. They are fully committed to the U.S.-only model now.
But selling assets like that
can
also signal some, financial pressure.
Absolutely. They acknowledge near-term headwinds, the need for fiscal discipline. They know it's tough right now.
So challenges are clear. But what about the future? They seem to be making big strategic plays.
They are. The big one is doubling down on domestic manufacturing here in the U.S., trying to build a more resilient supply chain.
And part of that is the new facility in Albuquerque, New Mexico?
Exactly. A big lease, 2 gigawatts of capacity planned. They're targeting early 2026 for production startup.
That's a major investment. The CEO is also talking about streamlining operations, cutting costs.
Necessary steps when revenue drops like that. They need to get leaner. This domestic manufacturing angle is crucial, though.
Especially with potential government help, like the Inflation Reduction Act.
That zero-many 7 per watt tax credit for domestic modules, that could be a game changer for their cost structure.
It sounds like they might be trying to replicate what some competitors, like First Solar, are doing, expanding U.S. production to capture those IRA benefits.
It's a logical path. The IRA really incentivizes this kind of move. That tax credit directly impacts their bottom line for every panel made here.
Makes their U.S. panels more competitive, potentially.
Potentially, yes. But the big question is, can they ramp up that Albuquerque facility fast enough before, the policy landscape shifts or competition heats up even more domestically?
Good point. Okay, let's dig into the red flags and strengths a bit more. Those ongoing U.S. customs issues. That's a definite risk, right? Holding up product.
A major operational risk. It directly impacts their ability to sell. And relying solely on this new U.S. strategy.
Yeah, in a potentially volatile policy environment, feels high stakes.
It is. Plus the financials we touched on, the revenue drop, and negative stockholder equity of negative $1.1 million. That suggests potential liquidity concerns.
Negative equity means liabilities exceed assets, essentially.
Basically, yes. It's a serious financial indicator. Not a comfortable position to be in.
Okay, but on the flip side, what are the strengths? Demand for high-efficiency panels is growing, especially for big utility projects.
True. That's a tailwind. And their technology, particularly the IBC interdigitated back contact tech, is a differentiator.
Right, the contacts are on the back, more efficient, maybe looks cleaner too.
Potentially, yes. It's premium tech. That could open doors for strategic partnerships, leveraging that advantage.
And they still have that R&D team in Silicon Valley working on next-gen stuff. That's a long-term asset.
Definitely. Innovation is key in solar. But that premium tech often comes with higher costs, too.
Which brings us to competition and market sentiment. Analysts had a $20 price target.
Yeah, but the report noted that might be a bit dated now, possibly before the full impact of these recent challenges was clear.
So take it with a grain of salt.
Yeah.
In competition is fierce SunPower, Enphase Energy. Big names.
Very competitive space. Maxeon's trying to stand out with quality and efficiency, but they're up against pressure from lower-cost producers constantly.
It's that classic tension, premium product versus cost competitiveness. Can they command that higher price?
And can that premium plus any IRA benefits be enough to offset the cost advantages competitors might have? That's the critical question.
Let's quickly run through some key financial metrics again. Trailing 12-month revenue, $689.01 million.
Right. And the PE ratio at 0.0x. Either no positive earnings or data unavailable basically confirms they're not profitable currently.
Long-term debt, $386.8 million. Quite a bit.
And paired with that negative stockholder equity, the price-to-book ratio isn't even applicable.
And no dividends being paid out currently.
Which is expected given the situation. They need to conserve cash or reinvest, not distribute it. These metrics really show a company under significant financial strain.
Okay, so let's try and wrap this up. Maxeon is clearly in a major transition period. Big bet on the U.S. market, big push into domestic manufacturing.
They have strong underlying technology, that's a plus. But they're navigating some really serious headwinds.
The import restrictions, the intense competition, the financial pressures.
It really feels like getting that Albuquerque plant online smoothly and resolving those customs issues are absolutely critical milestones to watch.
You can really see the tension here, can't you? Innovative tech versus harsh market realities.
It really crystallizes a key question for you, the listener. How do you weigh that potential upside of a strategic pivot against these very significant, very real near-term obstacles when you're evaluating an investment?
Something to definitely mull over as you follow Maxeon's story.
For sure. It's a complex situation.
Well, if you found this analysis insightful, please do subscribe, like, and comment.
Your engagement really helps us produce more of these analyses for you.
Thanks for tuning in to Investing Talk Podcast.